Hello. Thank you for joining us today on the Profit Scale Thrive podcast, where we guide attorneys to overflowing profits, scaled growth, and thriving lives. I am your host, Kelly Brubaker. We have a secret though. This is a special place because we don't work with every law firm owner. We support the solo attorneys who are also single parents because we know the special challenges you face, and we know the business advice out there is not always practical for you and your firm. Each week, we will talk about things that will give you the insight you need to stop feeling overwhelmed, to gain back your confidence, and to finally enjoy your law firm and your life again. Hello, and thanks for joining me today for podcast episode number 13. Welcome back, or for those who don't know me yet, my name is Kelly Brubaker. I am a CPA and a business coach who supports solo attorneys who are single parents. I'm also a certified Profit First professional, which means I help my clients implement the cash management system presented in the book Profit First, written by Mike Michalowicz. A few weeks ago, starting with episode 5 of my podcast, I began a dedicated series of episodes to share with you in detail, chapter by chapter, the book Profit First. If you have read the book, please follow along as I will share tips not in the book along the way. If you have not read the book, but you're curious about it, please stick around as we go through chapter by chapter. This week, we're talking about chapter 9, Profit First Advanced Techniques. We've done a lot of work so far to understand why Profit First works, how to use it, and how to customize it perfectly for our own business. And we only have a few chapters left to review. What we are going to talk about today are advanced techniques to customize Profit First even more for your business. But I caution, make sure you can answer yes to all of the following questions. Have you been following Profit First for more than 180 days? Are you making your allocations on the schedule you set, typically every other week? Are you building a balance in your profit account no matter the balance? And have you taken at least 2 profit distributions? If you can really honestly say yes to all of these, if you have mastered not breaking the rules, then let's move forward. The book is great at laying the foundation of the Profit First cash management method, but with over 33 million small businesses in the US in 2023, there are nuances that just can't be covered in the book. This chapter addresses some of the more common complexities we see when working with businesses implementing Profit First. The common answer to many different situations is going to be, when in doubt, open an account. So, advanced simplification. Does any of this apply to you? Some deposits you make are not from a sale. Maybe you get a retainer or a reimbursement of expenses. Or you know you have a large purchase coming up in the future. I know on the surface, opening a new account may not seem simple, but it is. When you can easily get clarity on your numbers, you can make better decisions faster, and you will become less likely to commit to projects, vendors, or expenses that do not fall in line with the balances in your accounts. So here's some ideas for additional accounts that will help you simplify your business. So the first one, the vault. The vault is an account to hold excess cash in an interest earning account that you can use for short-term emergencies. The goal of this account is to eventually hold 3 months minimum of your operating expenses. Sadly, it's not a question of whether you will ever need it, it's a question of when. I hate to invoke negative memories, but think back just 3 short years ago to March of 2020. Enough said. When you create a Vault account, you must define your rules for this account. Written rules. For example, if you have a drop in income, you know in advance that you will then trigger to also cut certain expenses if your income flow does not recover in 2 months. The key here is thinking through your rules before you need them. I know when I'm in panic mode, all logic flies out the window. This step is trying to prevent irrational reactions in a panic. Your cash flow may not improve for many reasons that are beyond your control, but we're putting plans into place to put the best fight possible. The goal of the Vault account is not to buy you time, but put you in a position to make important decisions early so you do not have to go into cash crisis. Okay, what about a stocking account? While my clients are law firms or other service-based businesses, you may think to skip this one because you don't hold inventory. Stock is an alternative word for inventory. But let's talk about it for a moment. If you need to buy batches of supplies, large batches that will be used slowly over time, this account can help you smooth out that cash flow. Mike's example is for a roofing and decking company. They need basic nuts and bolts for every project, maybe 100 for each project. But the problem is that their supplier requires a minimum order of 10,000 at a time at a price of 5,000. This quantity is expected to last 10 months. So this company will allocate $250 to this account every other week to fund the next purchase. The math on this is 250 per allocation when making allocations every other week for 10 months, which is 20 allocations. So $250 times 20 is 5,000. For my service-based businesses, think about using this account for your professional liability or malpractice insurance or software renewals that you pay annually. It's less of an impact to allocate 250 every other week than a one-time hit of $5,000. Let's talk about pass-through account. So my attorneys who are listening will understand how this one works. This functions the same as your IOLTA account. This account is to capture deposits you receive from clients that are not earned immediately upon receipt, meaning you need to do something per your contract to earn portions of the deposit over time. While your IOLTA account is required by your state bar, you may want to open a pass-through account for your client costs advanced. And here's why. The client reimburse you for costs you paid in advance on their behalf. This is not revenue to you. It's a refund of expenses that you've already paid. This account functions by transferring the money received in your income account that represents refunds, dollar for dollar, to this pass-through account immediately upon receipt. This is done so you do not allocate this money to your profit, tax, or owner's comp accounts. Then allocate the money to OpEx when you do your normal allocations. Alternatively, if you have the ability, deposit the money you know to be a deposit or reimbursement directly into the special account upon receipt. Some payment systems will let you do this if the invoice is set up a specific way. What about materials? A materials account. Remember back when we did the initial assessment, we took our total income and subtracted an amount for materials. Here's the account you place your money to pay for those materials. Never allocate money for materials to profit, tax, or owner's comp. Use it to fund your OpEx as you complete each job or project. This account is separate, so you know this money is off limits for anything except purchasing materials. What about a subcontractor or commission account? So along the same lines as the materials account, if you have to pay subs or pay commissions, use this account to hold that money until you pay it. Payments will be made from the OpEx account, so reimburse your OpEx as these obligations are paid out. What about an employee payroll account? For many businesses, payroll is relatively the same every payday. Allocate money to this account to cover your next payroll. Because payroll is typically paid on your behalf by a third-party vendor and the payments are routine and frequent, I recommend setting this account up as the payment account for your payroll directly, meaning do not allocate to this account, pay payroll from your OpEx, and reimburse your OpEx. So let's consider an equipment account. Similar to the stocking or inventory account, the equipment account should be used to save for large purchases, such as replacing your phone system, computers, or printers. Estimate the cost of these purchases. Take that amount and divide by the number of allocations you will be able to make between now and the expected purchase date. The result is your fixed amount to transfer every allocation day. So here's a fun one, DRIP account. We mentioned retainers earlier. This account is for retainers, but not for law firms. For law firms, a retainer needs to be deposited into the IOLTA account to keep the funds segregated from firm money. And your invoices are issued to clients for work performed, and the money is transferred from the IOLTA to the firm's operating account to pay each invoice issued. That's how it works per your state bar. A DRIP account would be used for companies that collect non-regulated retainers, deposits, or advance payments from clients for future work. To protect your cash flow, use this DRIP account to transfer the portion of the money you earned each allocation period to your income account for further allocations. To better explain, a website designer receives a deposit of $40,000 on a website redesign project that will take 4 months. Treat this deposit as a percentage of completion, meaning every other week you earn $5,000, which is 40,000 divided by 4 months, and then further divided by half to represent 2 weeks, if that's your allocation rhythm. If you place the entire 40,000 in income and allocate it immediately upon receipt, it will skew your accounts. Additionally, what if the project's canceled without completion and a portion of the money is owed back to the client as a refund? Play it safe and let the money drip into your income account over the life of the contract. So here's an old school account, petty cash. This was a common account when I first started working in the real world. I think now companies will use company credit cards as needed, but this account could be set up as a checking account so you do not have cash in the office, and set up a debit card that would be temporarily provided to an employee who needs it for small unexpected purchases. Things like flowers for admin day, a welcome box for a new employee or client, a retirement gift, or lunch as a reward for performance. Being a small account with a debit card, this functions to keep these type of expenditures less than they may be with a high balance credit card. What about a prepayment account? So some vendors will give you a discount for paying in advance or paying for a longer term instead of monthly. Use a prepayment account to set aside money to benefit from these discounts. So this does not apply to most law firms. I think there's a few states that have sales tax on professional services, but sales tax account. And this one's a big one for me if your business collects sales tax. This money is not your money. I can't scream it loud enough. Sales tax collected on your sales is always the government's money. You're acting as a collection agent on behalf of the government. Never, ever, ever, ever treat this money as income. Always keep it segregated from your company's money and remit it to the government when it's due. So what does this look like? Please appreciate that not all of the accounts I mentioned today will be in your account mix. Use the golden rule here. When in doubt, open an account. On page 155 of the book, Mike shows an example of what his accounts look like. I will put a copy in the transcript for reference, and you can check out my blog for this post episode. The thing that I want to point out is how Mike names his accounts. I do something similar. His naming convention is the account description, the current cap, and the TAP. This makes it easier when viewing your accounts online. Also, if you're trying to do your allocations when you're away from the office and away from your allocation spreadsheet, you can see from your account names what your caps are. So we're going to write down the process. Once you have decided which accounts you want to use, take one page. This doesn't need to be complicated. Write down the purpose of each account. Also note how money is added to each account and how money will leave that account. Be sure to include the current percentage or dollar amount of your allocations. Profit First is a system, and systems need to be documented for efficiency. This will help you to transition the allocations to your bookkeeper at some point. It will serve as a reference point for him or her, as well as a guide to help you keep them accountable. So here's something that I want to talk about. Shift your focus away from the monthly nut. Many business owners I talk to refer to this, their monthly nut. The old school idea that simply tells us how much money we need each month to keep our doors open. And let me tell you, it's nonsense. Because when you focus on the minimum to operate, guess what? You're focusing on your expenses, not profit. Get out of the survival trap now and forever. Stop focusing on expenses. Focus on profit, and the rest will fall in line. Focus instead on your income required for allocations. This is the money you need to deposit every other week to fund your next allocation. This is different than your monthly nut because it includes money to fund your tax, profit, and owner's comp accounts. To have a healthy business, to pay your adequate salary, and to take the profit you deserve, this is your focus. So, what happens when you have more than one business owner? Here's something to consider with your owner's comp account. If you have multiple owners being paid, be sure to adjust your TAP for owner's comp to cover all owners who work in the business. So, looking at the transcript, if you looked at the transcript, at the image of Mike's bank accounts, and you saw that Mike has $0 of profit and tax in those two accounts at Bank One, this is simply because at Bank One, those are hold accounts. Money is being allocated to them during the normal allocation process, but because it takes 2 to 3 days for your bank to complete the transfer to the inconvenient bank, aka bank number two. Bank number two has profit and tax accounts where the allocations are accumulating until they're needed. Mike adds a note, and I agree with this. If you have the ability to customize your online dashboard at your bank to not show the grand total of all account balances, please take advantage and turn it off. Easily seeing the grand total of all money can mess with your mind, so just don't do it. Let's talk about raising capital. Here's a unique situation, raising capital for expansion. Mike cautions against this, and I do too. It's risky, and if you are navigating this path, I hope you have an experienced team of financial experts working with you on this. If you are currently or planning to raise capital for future expansion, be sure to open a new account dedicated to hold these funds. How can you determine whether you can afford a new employee? So, you know that nagging feeling when you are over or understaffed, right? But when you're understaffed, how do you know when you can afford to hire? Here's a general rule. Your company should generate $150,000 to $200,000 in real revenue at a minimum per employee. Now, this is a ballpark number. Every business is different. Use this as a guide. And please note my emphasis on real revenue here, not income, real revenue. Go back to the profit assessment. So efficiency is always the goal, always. Not hiring your spouse's cousin who is down on her luck and could use a job. Remember that real revenue is the amount of income left after paying for materials and subs. If you think your business may be one of the unique ones that the general rule doesn't apply, use this backup rule. Real revenue needs to be 2.5 to 3 times the amount of your labor cost. So let's talk about some mini power tactics. You know, as soon as a book is published, there's more discovered, right? As tweaks to Profit First are discovered, Mike shares them on his blog, and I share them on mine too at profitscalethrive.com. So here's some of Mike's favorite tweaks. The government's money. It is so easy to borrow from our tax account. P.S. It's really stealing. The money is so tempting. It's just sitting there laughing at us. The problem is when we use the tax money today, we feel immense pain when your next tax payment's due. Remember that the IRS has the ability to put you in jail over tax issues. And when you're late paying the IRS, the penalties and interest can almost double the amount you owe. Bottom line, never borrow from your tax account. This is why we recommend moving your tax allocation to an inconvenient bank for holding. Go even further and rename that account online to the government's money. Put the roadblocks you need in front of you to not spend this money on anything except taxes. So hide accounts. Following the out of sight, out of mind theory, you are less likely to justify transferring money for an unintended purpose if you can't see it. If your bank allows you to hide accounts from your dashboard, you may want to use this strategy for all accounts except your OPEX. Outside income accounts. As online transactions have evolved, many businesses find that they have money coming into their accounts through a variety of sources. Think PayPal, Square, Stripe, etc. Don't let these accounts accumulate funds. These are income accounts holding money that needs to be allocated. Be sure to set these accounts for daily transfers to your income account. If you can't make these transfers automatically, then be sure to include a step in your allocation process to transfer these funds to your income account. The money you transfer today will be included in the next allocation cycle. Account snapshot. Does your bank have the ability to text or email you a summary of your account balances? Consider setting up these alerts strategically for your income and OPEX accounts on the day you do your allocations and 5 days later after all payments have been made from your OPEX. And if you set up a petty cash account, you may want a daily alert for this balance. Bank checks. Depending on how you issue checks, you may write a check, but the money's still in your account until it's cashed. If you use a bill payment service such as Melio Payments or Bill.com, they will pull the money from your account the same day you approve payment. But if you mail checks you print from your office, you may consider using bank checks. And the reason why is because bank checks are essentially you paying the bank the day you write the check, and the check is sent from the bank to the vendor. The bank will make money on the float, but if it helps you clarify your account balance, it may be worth employing this tactic. Trust me, the money you make on the float is going to be less than $5 to $10 a year, sadly. And now it's time for our listener's question of the week. Instead of a listener's question today, there's something mentioned in chapter 9 of Profit First that's something I would like to address here. We talk a lot about where money will be used or allocated, but what about total income? Are we bringing enough money into the business to support both your business and you personally? When I work with clients, I refer to this exercise as reverse engineering their owner's comp. Here's the thing. If your business does not make enough to pay its bills and your bills as its owners, your business is not healthy or successful. So I challenge you to do a checkup to make sure that you're not setting yourself up for failure with a billable rate that is way too low. Download my Billing Profitably calculator now to calculate the minimum hourly rate you need to bill in order to properly and profitably pay yourself and keep your business financially healthy. The link to download this easy calculator will be in the show notes, or you can find it here in the transcript. Download the calculator and let me know your results. If you would like to submit a question for a future episode, please send an email to podcast@profitscalethrive.com. And no, by sending an email, you will not get added to an email distribution list. There will not be a phone call made to you, and there will not be a sales pitch. We follow the golden rule: treat others as you wish to be treated. This week's inspirational quote is from an unknown source. I'm not saying building a business is easy, but making it hard doesn't mean you'll be successful. Final thoughts for today. I hope you're enjoying this approach to the book Profit First. Lots of ideas for advanced profit first techniques, which will follow our golden rule of when in doubt, open an account. Of everything discussed, the thing you need to do immediately is to stop focusing on your monthly nut and be sure to focus on your total allocation amount instead. Then for your homework this week, put a task on your to-do list for 6 months from now to revisit this episode. And I know that's far away, but much of what we talked about is for use after your initial accounts have been set up and you have a good routine on your allocations. Once this is old hat, you'll have a reminder to put your business on a path for the next level. If you have any questions about today's episode, feel free to comment if you are watching on YouTube, or send me an email to podcast@profitscalethrive.com. If you know someone who might need to hear this information, please share this episode with them, or if you're on YouTube, tag them below. Be sure to follow and subscribe to get notifications for future episodes. Did you enjoy this episode? Please consider leaving a review. And before I go, remember, profit is something you intentionally plan for in the beginning. It is not a potential bonus at the end of the year. Thanks, and have an amazing day.